Here's the worksheet for the statement of cash flows for Parker Corp. And I have taken the liberty of doing the current account adjustments already. So cash 57 went down to 41. We had a decrease of cash. That shows up over here at the very bottom. The receivables and inventories increased. Explains how we got from here to there. And so over here, we just told what happened and made the opposite entry. Same for prepaid expenses and accounts payable. Okay, so that's the first part. Now we'll do go through the additional information. So we get net income for the year 47,890. So we know that that's going to go right up here in our top of our operating section, and it increases retained earnings. All right, so we got that. Let's see, what else do we have? Oh, depreciation expense they give us is 55,000. So we know that that's an income statement account. It's going to go in the operating section, and they give us the amount of 55,000. Okay, the corresponding entry would be to accumulated depreciation, but if you'll notice, this problem's a little tricky. We've got buildings and equipment. We've got two accumulated depreciations. Now they don't tell us this 55,000, what goes with what. So we have to look a little bit further here, and it says we sold some land. That doesn't involve depreciation. We sold some equipment. Okay, so we know we sold some equipment, but we didn't sell any buildings. So when you sell something, a plant asset, you're going to end up with a debit to the accumulated depreciation. We're going to end up with a debit here, but this is the total difference between these two is going to be the current depreciation expense because we didn't sell any building. Okay, so 55,000 altogether, 20,000 of it must go with the building. So accumulated depreciation is going to be 20,000 for the building and 35,000 on the equipment for a total of the 55,000. So you see how these just get worse and worse as we go along. Yeah, okay. So there's that. Okay, we sold a charge for prepaid expenses. They just throw that in to mess with you. We don't have to do anything with that. It's like when you go into an office and you have a project to do, not everything on the desk relates to that project. You have to kind of pick and choose, oh yeah, I need this, this, and that. Yeah, well, you don't need the charges for prepaid expenses. Okay, so land was sold for cash at cost. Okay, no gains, no losses. So the land was on the books at 150, it ends up at 110. So we must have sold 40,000 worth of land. Okay, so 40,000 worth of land. Long-term asset, investing activity, so we just go over here and we say we sold some land. And we got $40,000. All right, so far so good. We paid some dividends of $84,290. All right, so we know that reduces retained earnings. And it's a financing activity, so we paid dividends of $84,290. All right. What else happens here? Is there anything else? Oh, I'm going to skip right down to additional equipment purchased for cash because that's easy. 80,000. Okay, so here's more equipment was bought for 80,000, and we simply say we, purchased equipment, and the other side of that entry would be a credit over here. All right, so I think we've done most of the easy stuff. Now we get to the assets that were sold. We got cash received from equipment sold of 37. They give us the original cost and they give us the book value. So we've got to recreate the journal entry and then, yeah. So what does it tell us? It says let's see, where am I going to do this that won't get in the way? I don't know. We'll just do it right here for now. All right. So we got cash on this transaction. We know that. of 37. We know we're gonna have accumulated depreciation. We know that the equipment has to come off the books at its cost. Okay, so we've got the cost of the equipment at 40,000. There we go, is that right? Yeah, 40,000. They give us the book value of 33. So that means if the cost is 40 and the book value is 33, then cost of 40 minus 7 accumulated depreciation would give us the 33 book value. So accumulated depreciation must be 7,000. Okay, and so our journal entry still doesn't add up, and that means that we have a gain on the sale. So 37, that's what, 44 of 4,000. Okay, so then we enter that more or less as it is. So cash is, you know, we sold some equipment, and so this is the proceeds. We got $37,000. That makes sense because these are sort of increases in the cash. Accumulated depreciation on, and we have to be careful, it's on the equipment, is 7,000, not the building. The gain, that goes in the operating section, so I'm going to get rid of this. So we have to do gain on the sale of equipment, and that's an income statement account, and so that, oh, and that, I'm sorry, that would be we're just doing it more, that would be a credit entry here, and, oh, we have to take the equipment off, and the cost of the equipment was the 40,000. Okay. So now we should see, oh, it looks like there's one more memo here. It says, we issued 30,000 shares of $1 par common stock to convert bonds payable at face value for $30,000. So, let's look here. So we converted stock to bond, or I'm sorry, the convertible bonds, we converted the bonds to stock. So the bonds went from 265 to 235. They decreased by 30,000. And notice that the stock went from 250 to 280, and that increased by 30,000. All right, now this is what you call a non-cash investing and financing activity. Was there any cash involved here? No, we just converted our bonds to common stock. And notice that the whole transaction, or both entries take place in the top section of the balance sheet, because this is the statement of cash flow effects, and it doesn't affect cash. So it just stays right up here. And so sometimes it's good to indicate somehow that, you know, this is a non-cash transaction, because that'll have to get reported on the statement of cash flows at the very bottom. Okay, so we would add up all the columns. I'm going to spare doing that. And, you know, we would find that, you know, that they should all add up properly here. I just want to make sure I haven't missed anything too important. Yes, so the only financing activity was we paid dividends, okay, because these were the financing that happened here. There's no cash involved. All right, so that's your basic worksheet, and this gives you all of the information that you need to prepare the actual statement, which is what we'll do next.